Hi, I'm Dave Monty. Welcome to my video series, Everything Villages. Today I'm going to do a market update. It is January 2023, so stay tuned. Before we get started, as always, if you like this video, please hit like. If you like my channel, please subscribe to it. Both those actions help these videos reach more people, and I greatly appreciate it. Also, if you'd like a copy of my free 42-page guide, Buying and Selling a Home in the Villages, you can email me right here at davemontysales@gmail.com. You can also email me for my Villages cost of living tool that kind of morphed into a full budgeting tool over time. Again, you can email me right here for that. Also, a little bit more of housekeeping. I'm just going to show you some of the other videos that I have here. If you're looking to kind of understand the market a little bit, the advantages and disadvantages of different area, this pricing part one is really good. This one talks about lot and features of the home that greatly affect pricing. I promised a part three, but I decided to skip it for a number of reasons. And if you're curious, ask me a question in comments. Biggest bang for your buck. A majority of the homes here that are on the market need a little bit of help. They might not have been updated in a while. Those tend to be your best value. You can pick those up at a pretty decent price, put some money into them and to add equity. A lot of times if you go buy a home that's already completely updated, you're going to pay a huge premium for that. All right. I have a cost of living calculator that we talked about in a little bit of the housekeeping, but these videos show you how to use it. Understanding the two markets between the VLS and MLS, that you do need two agents. Buying sight unseen. I got an example of a video that I did on a home there. And homeowners insurance, bond, tax. I got a lot of different videos. Probably going to be updating a couple of these here this month. All right. Now, the market is slowing down. How'd you like that? I had my little graphic there. So the market's slowing down a little bit. Interest rates have gone up. They've actually stabilized over the last couple of months in the low to mid sixes. There is a threat that the Fed is going to increase those rates again, and we might see another increase in mortgage rates. Now, is 6%, 7% bad? It's actually the average. We just got completely spoiled with incredibly low interest rates over the last 10 years or so. So even though they're increasing, they're still reasonable. Inventory is increasing. Part of that is due to the increase in interest rates. Part of that is also just due to the fact that I think there was a frenzy of selling and buying for a while, and that frenzy can't last forever. You run out of buyers, you run out of sellers, you run out of patience time and all that stuff. So I do think you're starting to see kind of, when things rise really quick, they tend to come down a little bit. All right. Prices have flattened out. We did see them drop in December slightly, and I'm going to show you that. Now, that might just be an anomaly. I do anticipate that they're going to stay flat, at least through busy season here. And then after busy season, kind of all bets are off, and we'll have to figure that out. I'm not going to talk too much about this new section opening. There's a really, the Village of Richmond right now, in my opinion, is a very good value. If you're looking to buy new south of 44, and you better buy it while you can. I do have another one. My last video that I did is why are homes less expensive south of Highway 44. Check that out for talking about the advantages and disadvantages of living down south there. The big thing is just the lack of amenities. And I'm talking about outside amenities. They still have rec centers and pools and golf options and all that stuff. But I'm talking about grocery stores and doctors and a Chinese restaurant and a Mexican restaurant. They're just lack of amenities down there. All right. Months of inventory. If you have watched any of my videos, you know what this is. So the people who have not seen these videos, month of inventory gives you kind of the health of the market, whether it's a buyer or seller's market. A balanced market is 6 months of inventory. Anything less is a seller's market. Anything above is a buyer's market. Currently, we have 286 homes on the market. How you figure out this number is you take the number of homes that are currently on the market, that's 286, divided by how fast homes have been selling, which is about, on average over the last 3 months, 88 homes per month. Again, we're in slow season right now, so this, causes it to dip a little bit in general. Okay, but if I divide those two out right now, we have 3.25 months of inventory, which is not bad. That's still a relatively healthy seller's market. And we have seen prices continue to flatten, if not tick up slightly, except for this last month, they did dip a little bit. Okay, so still a fairly healthy seller's market. Nowhere near, and I'll show you this on another graph, nowhere near where we were kind of at the peak of the frenzy buying, where we were counting months of inventory in days. All right. So let's take a look at the first thing, the active listings. This is the top of that ratio. So here's the active listings, and you can just notice that over time on the MLS, you started seeing active listings coming down, and then COVID hits, kind of the lockdowns, come out of the lockdowns, and you start seeing the inventories, or the inventory really drop. So this is the active listings dropping, remained really low for a while. Now you're starting to see them tick back up. All right. Number of sales coming over the last few years, pretty flat on average. Then COVID, the number of sales goes down, and then it really just ramped back up, and we're starting to come down to kind of a normal level of sales now. All right. While I had the data out, I just was curious, and I just wanted to see, check out where busy season is for buying here. Now, these are when homes close. And what I did indicate is just over the last 5 years, I just took the total number of homes that were sold in January, February, and March. Now, I could just, tell you the average, and just divide that number by 12, but the shape of this is going to be exactly the same. Okay, but really what it's saying here is this is the biggest month of closings, which means that most contracts happen in January and in February here. Still very healthy, contract, someone puts a contract in March and they're closing in these months. So, the very healthy time to sell or to buy. My opinion, the best time to buy here is actually a little bit into the summer. Inventories are fairly constant in the villages, and we'll talk about the reason why a little bit. But then you look at January, which is the least number of closings, and that's because people aren't buying around the holidays. And so that would possibly cause home prices to drop slightly in December. And I'm going to talk about that a little bit in detail. All right. Months of inventory. We were seeing a decline in inventory in the villages to begin with, and then COVID at the beginning, and then COVID as we were coming out of restrictions. Okay, and then just over time, over this last year, the months of inventory, have started creeping back up. Now they kind of went through the roof here. It looks like they went through the roof, but in general, we're still only at 4 months of inventory here, a little less. It's like this is 3.7 right there. But and you're starting to see that it dipped a little bit in December. Okay, all right, average days to sell is another indicator of the health of the market. The stronger the seller's market, the faster that the homes are selling. And that's what we're seeing. We saw a ridiculous average during the height where we were hovering around 10 to 20 days, which is kind of ridiculous on average. I mean, so the nice stuff was going in hours. The stuff that needed a little bit of help were still going in 30 or 40 days, but the average was real low. And what we're starting to see is that the average selling months, or the average days to sell is actually coming back up into the normal range here. All right. Sales price. Actually, let me get me out of the way a little bit. All right, sales price. Obviously, pricing tends to march up over time, and then boom, COVID, and it really went through the roof. And then we did start seeing it out. We started predicting this actually last January, that we thought that we were going to see prices flatten, which they have. Now, this is kind of a drop in December, and that could happen for a number of reasons. There's a lot of negative news in the right now, and about the housing market. So if someone has a house on the market, they're hearing that negative news, and it's been on the market for 30 days, and it used to be 10 days, it's been pretty easy to negotiate for buyers, the pricing down. So I think that's part of what you're seeing here is this kind of that overreaction to negative news. Now that we're coming into busy season, in my opinion, and again, can't hold me to this, but my opinion is you're going to see this pricing kind of come back out and flatten out. Now after busy season, all bets are off, and but we're going to talk about some of the things that we're seeing long range here. Okay. I do hear a lot of buyers come in and go, "Oh, prices have dropped." Well, what they're seeing is the price decreases on existing listings. So what has happened over this last fall is the sellers were way late getting the memo that the market changed. So you go on a listing appointment and it's like, well, we should be able to get this, and so-and-so got that. And you get trapped into trying to put a higher price on here. So and a lot of listing agents didn't see the market changing that rapidly, right? So what you're actually seeing is this line right here is list price, and this is selling price. What we started seeing is selling prices starting to go down. And when you see price decreases online, you're not seeing it decrease month over month or year over year. What you're still seeing an uptick in pricing. It's just the asking prices are getting a little bit closer to reality of what buyers are willing to spend. Okay, so we are still seeing, flat, if not a slight uptick in pricing again, except for December, and that just could be an anomaly, but we're going to learn more during busy season here. The big question is, where are prices going? Let's talk about things that affect the national home market. And now the Villages is separate from the national market, and we're going to talk about that. Again, if you've seen these videos, a little bit of this gets repetitive. There is some additional information because I did a lot more homework for this particular video on the national level, just because I've been hearing things all over the place. So there's more data points in there, but it's basically the same information. Okay, so for every percent of mortgage rates, you see an increase, you see a drop of 5% of the number of buyers. And we've actually seen that. What we haven't seen is this drop in home values yet. Prices have continued to tick up slightly, even nationwide. Now, when I first picked up this graph, this is the amount of confidence that people have. So maybe only 35% of people are confident in the housing market right now, and you're starting to see that dip. The average is, 56% of people are confident in the housing market. The reason I laugh is because if I look at the old graph, this was actually looked like it was further down. And I said, oh, it looks like things are improving. They're not improving. What's actually going on is they changed the scale over here to make it look a little bit better. But you can't help but not have confidence in the market right now because all you hear is negative news, negative, negative, negative. And that tends to, draw clicks more than positive news, or draw viewers more than positive news. So negative news always wins over positive news. The confidence is low right now, but what's actually happening in the industry is that both buyers and sellers are being scared out of the market slightly. So you're still seeing a fairly, strong seller's market because we're not doing this, we're doing this. All right. Another data point, this is actually off Freddie Mac. I should have put a little source thing down here, but this is off Freddie Mac. 21% are likely to buy homes in the next 6 months. Now, more importantly, that's a 2% increase over last quarter. So you have more people now thinking of buying a home. Like on the other side of the sellers, you're seeing a 1% decrease in the number of sellers. So in that case, you're actually lowering supply and increasing demand, which in my opinion means that home prices will sort of remain flat because there's some other, because of, interest rates will affect things. So there's other things that will affect it other than just the number of people willing to buy and sell. Here are a bunch of different analysts and what they're predicting. And there's a big chunk who are actually predicting a 20% decrease down in here. You got a lot of people expecting decrease. Some people, Realtor.com, their analysts are saying a 5.4% increase. Home.llc is a 4% increase. I'm not going to read all these. And then gradually they get higher decreases. Some of these, I took the average because they gave a range. So I took an average of what they said. But really that averages out to 7.4% decline in home prices. Okay, so that's what the experts are predicting as an aggregate nationally. I'm going to talk about why this is the case in the slides coming up, but typically in the Villages, or at least what we saw during the 2008 and 2009 housing crash, is that home prices in the Villages remained higher, or dropped less, I should say. They dropped less than nationally by a factor of 3 to 1. Nationally, it was 33, 34%. Here it was 9, 10%. So, we did see a decrease in pricing here in the Villages, but it was nowhere near what happened nationally. So if you just take a look at that, 3 to 1, you're looking at possibly, if I'm using national averages and just doing that 3 to 1, you might see a 2% drop in pricing over the course of this year. So I'm going to put a little pin in that, and we'll see what happens by the end of the year to see if I do have a crystal ball. Supply control. So in the Villages, last year, there was approximately 7,000 homes sold. 60% of them are new. You have one entity, that's the developer of the Villages, who is controlling a large chunk of the market. They have the ability, if they want, who knows if they will, to throttle back on building slightly in order to maintain pricing in the villages. So they do have a little bit of control over the overall market here, which is crazy for one developer to have that much power, but they do. Baby boomers. So we are still seeing an increase in demand, 10,000 new retirees a day. But here's what's more important is that the number of people over the age of 65 is continuing to decline. People are living longer. The baby boomers, while they're not retiring anymore, are going to stop retiring here in a couple of years. That big group is going to continue to age. Okay, so and let's just take a look out 20 years here. So you're going to have 30 million or 25 million more retirees or more people over the age of 65. So you're going to continue to see demand, and you're going to continue to see people living longer and staying in their homes in the villages longer. So retirees don't lose jobs. They have larger, more diversified portfolios. And then the interest rates don't hit them as hard. Now, it is going to hit a certain segment. It will hit the investors. The people who are buying rental properties don't like higher interest rates, because with a higher interest rate, they're not as cash flow positive and probably a little bit cash flow negative. They use the bank's money in order to make more money. Most investors don't take large chunks of cash and buy things in cash. So it does affect that a little bit. So we're seeing, before when a turnkey home came on the market, those were being snapped up by investors like this. Now the turnkey homes are not selling quite as fast. The reason it doesn't affect here as much is because a lot of the retirees have the ability to pay cash. And I think the number here is like 60 to 65% of buyers pay cash in the villages. One big disadvantage, right, a little fly in the ointment here, is inflation. What's making me a little bit nervous in the market is China relaxing their COVID restrictions. Now, that's a good thing for them, but that means increase in demand on gas. That means increased demand on goods and everything like that. I actually think you're going to see another big jump in inflation this year, but that's just off, a couple of data points. So inflation would hit the retirees. But as of right now, it seems like inflation has gone through the roof and is actually also settling out a little bit. Okay. Another thing that hits demand is compelling events. Now, a lot of people hear this, and I hear my buyers say, I do not want to make the same mistake everyone else makes, which is move 3 times while they're here in the villages. Well, the reason why people move 3 times isn't necessarily that they bought something wrong or they changed their mind about what they want. And that does happen, obviously. But typically it's a compelling event, usually centered around some sort of health event, or with only one partner left and they can't take care of the home and they want to downsize. One of their parents passes away and now they want to upsize. You have a pretty large demand. You have the ability to control supply somewhat here in the villages. An aging population, all those things are going to, cause the villages to weather a market downturn much better than most locations. And again, probably in a 3-to-1 type of a ratio. When you kind of ask why they even went down during 2008 and 2009, in my opinion, it wasn't because there was a lack of demand. It's because people couldn't sell their homes up north. So if you can't sell your home up north for what you need to get out of the house, or people are just not buying homes, and a lot of people need the proceeds from the home up north in order to buy a home here, that did affect the market. Not because demand went down, but because the ability to buy here in the villages went down. I put this same slide I've been using all along. Is it a good time to buy? Let's make the premise that the market is going to crash here in the villages, or the market is going to crash nationally, not just in the villages. So is it a good time to buy? Well, this is the same exact slide that I've had over the last few market updates. Now, if you're moving into the villages, what we're going to assume is that the villages is a safer place to put the money. Let's assume that the market is going to crash nationally. Right? So that's the worst case scenario. So if that's the case, and it's a 3-to-1 here, this is a safer place to put money. Right? So if you're going to go with same price home into the villages, if you can sell your home up north for what it's worth and you buy something comparable here in the villages, this is a safer place to have that money. Are you going to downsize? Yes. So downsizing into the villages, you're coming into a safer place, and then you're putting less money in the real estate. It's like moving your portfolio around. So now I have less money in real estate. I think that's, if you do think the market's going to crash, take money out of the real estate. Okay, so now is actually a fantastic time to downsize into the villages. So upsizing into the villages, it's a little bit of a math problem, right? So if you've got I'm going to use round numbers just because they're easier to use. $1 million, right? So you have $1 million home up north, and that thing is going to decrease by a whopping 30% like it did in 2008. So you just lost $300,000. Now you upsize into the villages, and say you upsize, and now it's $1.5 million home in the villages. Again, I'm just using round numbers, and that reduces by 10%. You only lost $150,000. So it's actually not a bad time to even think about upsizing. And again, I'm just using round numbers and big numbers there. All right. Same price within the villages. That's an even move. You're not putting any more money into the market. But usually people don't do kind of same price unless they're going from like a designer to a pretty nice villa and they're just moving into the villa for reduced maintenance. Upsizing in the villages. If you think the market's going to crash, do you want to put more money into the real estate market? I wouldn't. So unless the other compelling events happen, like you came into some money or things like that. All right. Downsizing in the villages, a great time to downsize. Take less money, take money out of the market if you think that the market is going to decline from this point on. All right. Key takeaways: market is slowing, prices are flattening. They might come down, but we'll see during busy season. We are seeing better inventories. It is a much better buying environment for buyers. You're not. I haven't had a multiple offer situation in probably the last 6 or 7 months, which is pretty nice. Interest rates seem to be leveling off again, but we're hearing news of the Fed possibly hiking again here pretty soon. And again, if you believe the housing market is going to crash, this is a good place to have your money. All right. So I hope you found this video informative. Again, if you like the video, please hit like. If you like my channel, please subscribe. If you like a copy of my 42-page guide, buying and selling a home in the villages, just email me right here and I'll send you out a copy. If you like a copy of my cost of living calculator / budgeting tool, again, email me right here at davemontysales@gmail.com. I hope to be seeing you around the villages. Take care.